Today I will be sharing my first attempt at a Palantir DCF. I have bear, base, and bull cases laid out here, and I pulled most of this information in from Bloomberg here, the Bloomberg setup and what analysts are expecting, but of course I tweaked it for my different growth rates. So first, I'll show you how I have this set up. So just for context, I based this off of Tom Nash's setup for his DCF, in which he shows off Palantir. It's more of a simple DCF, not too much going on, and just a one-pager, but definitely a good place to start and sort of model things out. And again, this is my first attempt at a DCF for Palantir, so we'll see how it goes. So before I even start explaining this, why would we want to do a DCF? Why is that even necessary? Well, I think it's important to be able to think through, even if it's not 100% accurate, a more fair value for a stock, especially when the market is in an outright downfall. So that's what we will be doing today. Everything you'll see here is in millions because that is how Bloomberg presented it to me. We're looking at a $2 billion 12-month revenue for the year of 2022. And here in my bear case, I have us compounding at 30% growth for this 5-year period, because this is a 5-year DCF. So you'll see what that looks like, carrying out to about 7.4 billion in 2027. You'll see this is pretty consistent with what Palantir is guiding for, greater than $4 billion in the year 2025, and 30%, which is their guidance, in excess of 30%, actually carries them beyond the $4 billion target. So once again, for revenue, this is their guidance. They say they will actually exceed this. So this 30% compound number for revenue is actually under their guidance, so this would be them missing their guidance. Now, for the cost of revenues, SG&A and R&D, these are non-GAAP figures because you have to back out the stock-based compensation, but carrying these forward, I put a 25% increase rate on all three of these, which is pretty aggressive. That is what I have done, so you see how these expenses increase over time. Now, the EBITDA, that's earnings before interest, taxes, depreciation, and amortization, and we are just subtracting these, just keep it really simple. And then you'll see that all the way across. Now for the EBIT, that would be after dealing with depreciation and amortization, which I got from the Bloomberg terminal right here, which is 20. You'll see it carry across, so I just subtract out the depreciation and amortization, and then we get the tax rate, 21%. It's going to be under in some cases, over in others, but I think 21% is just fine for our use case here. It's not going to do too much either way. And then we get to the net income, which is subtracting these and factoring in the tax, if there is any, which again, we're just assuming it's 21% all the way across. And there we have our earnings essentially. And then there's the CapEx, which again, I just got these figures from Bloomberg. We've got the net working capital, which would be the assets and less the liabilities. And then the free cash flow here for each period is just subtracting those. So the earnings minus the CapEx minus the net working capital all the way across. Now for this discounted cash flow model, we are using a discount rate of 10%, which is pretty standard. I'll be using this on all three of the models. I know usually you change the discount rate, but I'll just be using 10% here. And that's the thing that's really tricky about DCFs, is one change to this can really do a lot and change the output very much. So I'll just be leaving it at 10%. Keep in mind, changing the discount rate can really have a big impact on the final result, but 10% is what we're using here. And then you get the present values of the cash flows, and that's where the discounting comes into play, which you'll see how it gets discounted is down here. If you wanted to look at that, that's just the math behind it. And then we get the present value, which is just a sum of all of those cash flows. So here we go. In the bear case, this is what I have laid out here. Now keep in mind, this isn't actually doing anything. I just had this included because that's what I saw from Tom. I'm actually not too certain about how an EBITDA multiple, I'm not confident enough in an EBITDA multiple what to put for Palantir, so I am not using this to make a calculation, so keep that in mind. this DCF up here is the only thing I'm using with the perpetual growth valuation. So let me explain that. The long-term growth rate, so I told you how this is 30% all the way up here. Now we know Palantir can't grow 30% forever. No company can. The theory is that no company can grow greater long-term than the growth of the GDP. It's just not really possible to exceed the GDP. And we have Palantir down here at a 3% long-term growth rate, which is, I think, a good figure for a bear case. Not too much to worry about there. I think 3% is actually pretty good. You'll see in my bull case, I have it up to 4%, which is what Tom had actually suggested in his model. And then what are we doing here? Well, we're taking the final year, which is 2027, and we are adding to it the growth rate. And then we get the terminal value in the final year right here, and then we discount that present value of the terminal value. So essentially we get a value of rounding it up, $22 billion. And lastly, we're taking the sum from up here that we already talked about, and we are adding to it the perpetual growth rate and subtracting the net debt, which is actually just cash because Palantir is debt-free at this moment. So there you have it, $22 billion, which compared to the current price at around $27 billion for the stock represents an actual downside of 18%, down to approximately $11 a share. So this is my bear case. And what you might realize is all of a sudden things can look pretty bad pretty quick, bringing Palantir back to their DPO price. But once again, what you will see is I'm actually modeling in this bear case for them to not even reach their conservative guidance. And for them to miss their guidance, I don't think it would be crazy for the stock to be at $11 per share, around that level. And if that were to happen, I think that could definitely be a possible level. But now let's move on to my base case for Palantir in this model. And that is them growing at a 35% growth rate. I think that is a pretty good base case. I think that's largely where they're going to end up, and that would be 30% compounding for actually a $5 billion revenue in 2025 when they're aiming for 4, or they're saying we are going to exceed significantly 4 billion. That would bring us to about 9 billion in 2027. Anyways, so on the cost of revenue is also sometimes known as the cost of goods. But for Palantir, I just labeled it the cost of revenue. I said that's going to increase even more by 30%, because if they're doing more in revenue, I say they probably be, obviously it's going to increase, but I think they will have some leverage over time. So if the revenue is increasing by 35%, I don't think it's crazy to say the cost of the revenue is only going to increase by 30%. I think they will have leverage. They've talked about their marginal cost to deploy their software. They're trying to drop that as much as they can. So I just made that 30. And then we've got the SG&A here growing at 15%, which from what I saw from the Bloomberg estimates isn't too offline, is actually pretty accurate in terms of what the analysts are expecting. So I went with that. And then for the R&D, 30%, which I think is pretty on top of things. I think that's a pretty good place to be, and they can probably grow into that pretty well. R&D to spin off new products and increase the revenue with better product development and the like. So I'm not going to walk through the EBITDA, EBIT, tax rate, net income again, and then CapEx, net working capital, free cash flow. Didn't change anything there. We're keeping a 10% discount rate. Here are the present values, which sum into this right here. And here we go. Here is the result of my base case. And I'll just touch on the EBITDA. Again, I didn't do anything with this, but if you're interested in what a 15 times EBITDA multiple looks like, it would be almost $50 billion of enterprise value. Now, for the long-term growth rate, 3.5%, and that's almost corresponding with my 35%, not that that means anything. And then we've got, once again, the final year plus the growth rate, terminal value in the final year, and all the way down to the DCF value. Nothing changing in terms of debt and cash. We're just keeping the cash there at their current level, or around their current level. I didn't check exactly. Gives us a DCF price of $43 billion with our current market cap of 27. billion, which represents a 57% upside, a share price of around $21 per share. So this is currently my base case for Palantir. The more that I think about it, the better that seems. That would put Palantir back in the range of the 20s up to 30s. But the thing with the DCF is really anything can happen. The DCF is more just fundamentally based, and if the market wants to value Palantir more, it will be higher priced. If the market wants to value it less, like they're doing right now, for instance, if I truly do think Palantir is worth $21, it's not getting any of that right now. So once again, this DCF really doesn't mean anything. It doesn't mean that even if all of these values were completely correct and that's the true intrinsic value of the company, that doesn't mean the stock is actually going to trade near these levels. It really depends upon the market. I'm actually pretty happy with a $21 price as a base case, considering where the stock is today, significantly lower, over 50% lower than it is right now. And then the bull case. So in the bull case, I'm expecting revenue growth of 40% all the way through, and that would be really a bull case. Like, let me tell you, that would be incredible. They've done a couple years at 40% revenue growth, but it is going to be pretty hard to keep it up that high, but that would be great. And what I'm just realizing is, okay, I did increase the cost of revenue to 35%, but maybe I want to be a little more conservative and make it 37.5. So I'll increase that all the way across, because increasing the revenue by 40 and the cost of the revenue by less than that wouldn't make too much sense. So SG&A, I'm having it increase by 10%, expecting the best there in the bull case. Maybe their SG&A doesn't really go up that much. Wall Street is not expecting it to go up a ton. And then we have the R&D down here at 30%. Maybe I could increase it to 35. I just did. Here we go. Here's the setup. Once again, we're getting down here and we see a perpetual growth rate. I've increased that to 4%. What Palantir will do in a bull case beyond these years that we are outlining there, that brings us to $60 billion. And there's our net debt, which is just cash, and $60 billion for the company. And if we have a $27 billion market cap, that represents over 100% upside at $30 share price, pretty much. Now, what is that relying upon? That is relying upon 40% growth, which is 10% higher than what the company is guiding for. Now, is it impossible? No. Is it probable? Probably not. If I was going to say if this is possible, this could probably be a 15 to 25% probable scenario at this point. I mean, this is why I keep talking about needing to see this next quarter. How is the core intrinsic business doing? How is the growth doing? How is it progressing? How's the company doing? Q3 was a little seasonally weak. So what is Q4 looking like? We need to see that to get the update. Maybe Q4 is more seasonally strong and we can get a better sense for how the growth is going. They talk about new initiatives and the like, but here we go. This is my bear, base, and bull case. A bear case of $11, which at this point is not that far away. Back to the DPO price, which would be pretty shocking, but that is, once again, if Palantir, as I'm modeling it, misses their guidance, which I already consider pretty conservative, so I am not expecting this to happen. Again, the market can do whatever it wants, whenever it wants. In terms of my numbers here, doesn't make much sense for Palantir to be trading at $11 unless they are missing their guidance. And then we have my base case here. Again, I'm sure I'm going to need to tinker lots of this, correct lots of it over time, but I have this revenue growth of 35%. I think this is a lot more realistic of a scenario. 35% is probably how they're tracking at this point, and that's roughly a $21 share price, which is back into the 20s. That would put the stock back in the range where it used to trade. I consider this much more of a realistic scenario for this DCF. And keep in mind that a DCF target price, as I'm putting this out here, doesn't mean the stock will never rise above it. It means that is theoretically, in a DCF theory, what the stock should be trading at because of the discount rate. It doesn't mean Palantir is never going to rise above it. It means Palantir will rise above it over time, over the years, and realistically, it should be trading at this value. This is certainly not financial advice. This is just me trying to plot some things out with numbers. And lastly, we have our $30 target price. That is if Palantir is doing 40% growth. So I tried to keep things mostly conservative on the increasing of the cost of revenues, SG&A, and R&D throughout all these scenarios, but you'll see what the growth really does to all of these different ones. If Palantir misses guidance, the stock is really going to suffer. If Palantir is in line, I think the stock should be where it was before it has fallen down in the macro conditions. And if Palantir is able to exceed its guidance considerably, potentially $30 is just the start. So that's where I'll leave it for now. Let me know what you're thinking. Let me know if I made any glaring mistakes in my analysis here. This was a long-awaited request, and hopefully it is helpful, at least in some regard. Again, not financial advice, but wanted to share this after I spent a few hours making it. Until next time.